the banks are in trouble. And not only that, no one wants to leave their money in the bank. They'd rather move it to treasuries, which short-term treasuries with disintermediating the bank, or even into money markets away from the regional banks and into the bigger banks. The problems are not done yet. And this is a good sign of it. When they are trading their mortgage-backed securities instead of their treasuries, they're in need for cash, and cash quick, and they're in trouble. It's kind of like, you're pawning off your wedding ring at this point, and hopefully you'll lend it to the pawn shop. Hopefully you'll buy it back because your other assets are already gone. And it's a very scary sign, to be honest with you.
Massive news from India today. India unleashes silver as bank collateral with 10-to-1 gold-silver ratio, boosting global money roll. India formally recognizes silver as bank collateral with a 10-to-1 gold-silver ratio, reshaping lending, boosting demand, and igniting a new era for silver as a global monetary metal. India has taken a historic step toward the remonetization of silver, officially allowing the white metal to serve as collateral for bank and non-bank loans under new Reserve Bank of India regulations set to take effect in April 2026. The move effectively establishes a 10-to-1 silver to gold ratio in collateral lending, marking the first time a major economy has formally recognized silver's role alongside gold in modern banking. Silver joins gold in India's banking system. For decades, Indian households have relied on gold jewelry as a primary form of collateral for personal and business loans, especially in rural areas with limited access to credit. The new rules expand that privilege to silver jewelry and ornaments, enabling borrowers to pledge up to 10 kilograms of silver or 1 kilogram of gold as collateral for loans of up to 2.5 lakh, approximately 3,000 USD. The policy applies to both banks and non-banking financial companies, a sector that services millions of small borrowers, and introduces uniform valuation and documentation standards to ensure transparency. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
The largest silver refinery in India evidently has run out of stock for the first time in history. India being one of the largest buyers of physical silver, that's a big deal. I think worth certainly mentioning. The managed money is short by over $1 billion on silver, meaning the commercial banks took the other side. I wonder how that's going to play out. I would suspect you'll see silver really start to move this week when the managed money, the dumb money, in relation to the commercial banks, the ones that seem to always be on the right side of the trade until one day they're not. And maybe this is the one day one would expect silver to really start to move higher here right now. I don't like to make those kind of predictions, but I will tell you that this is very unusual to see how short the managed money is. At the same time, you have, right now that the LBMA is blowing up in terms of running out of stock, you have, for the 18th day in a row, backwardation between spot and futures. Right now, it's about $1.24. This tells you that the people are paying extra to get real silver now, not in the future. This is not bearish. This is a panic for the real metal. At the same time, short sellers are now paying a 19% annualized rate just to borrow SLV shares, where we see a lot of shorting, and a 39% lease rate on the LBMA. This is not indicative of a well-functioning market. Bank of America on Monday raised its forecast of silver to 65 per ounce by next year, with an average of 56 and a quarter. Until then, they also lifted their outlook to gold for 5,000. And the last thing that I will say is, and I may have repeated this last week, but for people who haven't heard this, you got 4 or 5 things that are incredibly bullish. You got, as we mentioned before, Morgan Stanley saying no more 60-40, 60-20-20. Get rid of half your bonds, buy gold with the other half. 60% stock, 20 bond, 20 gold. When have you ever heard a financial advisor say 20% in gold? This is from their chief investment officer, their CIO. This guy and the people that I'm about to mention speak to not the plebes, but to the institutional level traders, not to the rest of us. They're saying put 20% of your money in gold and pare down your bond holdings by 20%. Michael Hartnett for Bank of America, this is the one that just said, 60, whatever, $65 on silver. Michael Hartnett's newsletter, I don't know how much it is, but I bet it's 10 grand a year. He just came out and said, no, it's 25, 25, 25, 25. 25% stock, 25% bond, 25% short-term treasury, and 25% gold. Whoa. Then you get Jeffries. Now, as you mentioned at the onset of this meeting, we were blessed by Prudential Beige about 20 years ago, and they nominated us. The authorized resellers, the 6 or 7 of them, can nominate one primary reseller, the primary distributors can authorize one authorized reseller. And they did. Prudential Beige authorized us or nominated us to be an authorized reseller, one of 27, about 2 decades ago. God bless them for that. Walter Pahowicz, if he's still out there, Walter, I love you. He used to run their desk. They got bought by Jeffries. And Jeffries Beige was the name. Jeffries Beige was a primary distributor for all the major mints. They understand gold. They subsequently got out of the market, sold off the Beige name, and it's just Jeffries. Their head trader is saying $6,600 gold is their next stop. They understand gold. But maybe the biggest of them all is Jeffrey Gundlach, the bond king, the man who's made his mark, his fortune, and his moniker of being the bond king by selling bonds, who just came out and said a 25% portfolio allocation to gold is not overweight. Really? So when you see these people at these levels, and then put into it all the stuff coming into COMEX and the draining on the LBMA and the high lease rates and all of this stuff, the Judy Sheltons of the world, and the Trump saying he who has the gold makes the rules, and Bessent saying, I want to remonetize, be part of a new monetary. Keep going. I'll keep going. And I'm telling you, and I hate to say it, I cringe saying it, but this time it's different. And look at gold. Got the snot kicked out of it by over $100 last week on Friday. And what are we at today? We're up $108 right now as we speak. The physical demand is different than I have ever seen, as are all of these things. People at that level, speaking to institutional traders at that level, saying 25% allocation is good. Never seen that before, man. Not even close. That's all I got. That's a mic drop moment.
In today's gold's headlines, Morgan Stanley says gold's rally will likely go on. Gold broke a new record high on October 10, surpassing $4,000 per ounce for the first time, and continued to climb since then. On October 21, the rally hit a wall with a drop of as much as 6%, the biggest daily loss in 12 years. Still, gold has surged about 50% in 2025, cementing its status as one of 2025's top performing assets. The price increases are a reaction to major policy, geopolitical, and economic developments this year, including tariffs, the Israel-Hamas conflict, concerns about the Federal Reserve's independence, and the U.S. government shutdown. Morgan Stanley Research expects the rally to continue and revised its 2026 gold forecast upward to $4,400 per ounce, a significant increase from its previous estimate of $3,313. The new projection implies an additional gain of about 10% from early October to the end of next year. I don't know about you guys, but the fact that all big banks are screaming bullish headlines lately is starting to become a massive red flag in my book that gold prices could take a deeper dip this time. What do you think? See, investors are watching gold not just as a hedge against inflation, but as a barometer for everything from central bank policy to geopolitical risk, says Morgan Stanley Metals and mining commodity strategist Amy Gower. We see further upside in gold driven by a falling U.S. dollar, strong ETF buying, continued central bank purchases, and a backdrop of uncertainty supporting demand for this safe haven asset. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
First of all, there are other grading services. The premier grading services are PCGS and NGC. PCGS, the professional coin grading service, right there. They're part of Collectors Universe, publicly traded company, and the Numismatic Guarantee Company. And these two companies do nothing but standardize the industry. Now, if we're talking common $20 gold pieces, that should never happen. Never, ever happen. With one caveat. When you get up into higher graded coins, and 64 on the Saint or a Lib really isn't that high at all, but when you get up into higher graded coins or rarer coins based upon age and scarcity and whatnot, PCGS came out with something called CAC grading, which is just a step above. In other words, there are different levels of 64s and whatnot in the respect that, how can I say this? Like, eye appeal, right? The coin may classify as a 64, and it is a 64. For the guy to say it's not a 64 if it's PCGS and NGC is absolute crap. However, there is an issue with eye appeal, and one 64 may not look as good as another 64, and that is true. And CAC grading came out, and I don't know what it's NGC Star or NGC Plus, I don't remember, but they're coins that are very clean. So sometimes when a coin is certified, and in this holder here, it's hermetically sealed. But if a little drop of air gets in there when they're sealing it, over time, that air can create a copper spot because they're not pure gold. They were used as legal tender. So there's alloy in them. That little bit of air over time would create spotting. And there might be other examples of a 64 that looks like a 65 or a 66 and one that looks like a 63. In higher graded coins and more expensive coins, that is legit. That's why they had it. And again, it's really a knock against them, I guess you could say, of having to come out with 64 CAC or, PCGS CAC. And I forget what it even stands for, but it basically means it's got great eye appeal. Look, when you're buying, this is the whole thing about buying numismatics. For me, if I'm going to buy numismatic coins, I am going to buy semi-numismatic coins, common stuff up through grade 64, 65, where you don't ever have to worry about that. If you're going to get into numismatics and you're going to start collecting higher price stuff, rarer stuff, you need to immerse yourself in the nuances like this. But I don't know which company it is, but I will tell you this, that if anyone were to send me back 500 MS64s right now, St. Gaudens, they would never, ever hear from me saying, those didn't measure up. That is not true. That is not true. They are standardized. And I guess I'd have to see the story at greater length to have a little bit more of a perspective. But here again, shouldn't happen in general unless it's a really rare or expensive or high grade coin.
What do you think of Schectman's take? Do you agree that a massive gold and silver squeeze could happen in December? Is he just talking his book? Will gold and silver top very soon? Post in the comment section down below your honest opinion. Hype the video if you liked it. And make sure to watch this one right here because it's a perfect fit for you. And I'll see you on the other side.